Hello and welcome to this month's webinar, which today is concerned with the new rules that recently came into effect for your non-domiciled clients. I'm joined by my co-host and longtime colleague Tony Court, another of our in-house experts at Tax Essentials for Advisors. As with our first webinar, we do welcome questions in the Q&A section. We will do our best to answer them towards the end of the session, but of course, if that's not possible, I will put my email address in the chat so that you can follow up with us later on. I'm also delighted to welcome our guest panelist, Rachel Brown, who I worked with many years ago at Ernst & Young. Rachel is currently a personal tax manager at boutique firm Claritas Tax and was the Chartered Institute of Taxation's 20,000th member recently. Okay, let's get started. Tony, in fact, while these rules have been dubbed the non-dom tax rate, there are actually other people that are going to be affected as well, aren't there?
Yeah, that's right, Andy. It affects anyone who was resident or living outside of the UK and either comes to the UK or, in fact, has recently come to the UK, regardless of what their domicile is. Domicile is a separate issue from tax residency, as you know, and over the last 20 years or so, the concept of domicile and tax residency has changed quite significantly. It's that the new rules are that coming in are quite different from the old rules in that they, instead of concentrating on domicile, it turns on the question of tax residency. So the concept of domicile becomes moribund. Tax residency is in the ascendancy. The only other thing I would say, of course, is that the domicile concept of domicile is not just a tax issue. It's a general law issue for immigration and residency purposes, and the two shouldn't get confused, as the rules for tax are quite separate now and quite different from the general rules. I hope that answers that point, Andy.
Yeah, thanks, Tony. For context, I mean, perhaps we should start by giving a brief summary of what the old rules up to the 5th of April this year were. Could you just run through those for us, Tony?
Yeah, sure. So up to and including the year 24-25, if you spent any significant time in the UK, you could become tax resident for UK tax purposes. Now that was a very difficult test, which used to be determined by a set of informal rules until such time as the statutory residence test for tax purposes was introduced, I think, in 2013. Now, that was aimed to regularise the position, although there is still some subjectivity, but at least there is now a statutory definition of residence. In contrast, there was and it is still no statutory test for domicile, and indeed, as I've already mentioned, domicile ceases to become an important issue from April this year for tax purposes. So it is possible to be domiciled in the UK for non-tax purposes but resident in the UK for tax purposes. Now, up to and including 24/5, if you were resident, or indeed currently, if you're resident in the UK for tax purposes, you're liable to UK income tax on your worldwide income. So the rules haven't changed that now. But prior to April of this year, if you were not domiciled in the UK, you could opt to be taxed only on your income which arose outside the UK, provided you did not remit it to the UK. So if it was earned outside of the UK, providing it stayed overseas and you didn't use it to settle UK liabilities or actually just bring the money in, you could just be taxed on your UK income or anything you brought into the UK. This was known as the remittance basis. And it was freely available to anyone who was not domiciled for a period of 7 years. After that, there was, if you wanted to maintain the remittance basis, you had to pay a significant annual charge unless your income from overseas was less than £2,000 a year, in which case you didn't need to pay anything. So from April 25, the position is quite different. So, and I think Rachel is going to help us out here with some information now about the new regime. So, can you, Rachel, sum up the changes that came into force for 25/6 and later years?
Yeah, of course. So you've definitely covered there how complicated the old rules were, and that's one of the reasons for these changes is to try and make everything a bit simpler. So from April just gone, the current tax year, everyone who's UK resident is going to be taxed on their worldwide income and gains as they arise, and that's regardless of whether they bring it into the UK or not. And the government says that this will make the system fairer and more in line with how other countries tax their residents. But there are some cushions. So if someone is coming to the UK for the first time, or at least 10 after 10 years away, they get a special break for the first 4 tax years, which is known as the 4-year foreign income and gains regime, or the FIG regime. And there's also a new system for inheritance tax, which will now be based on how long your client has lived in the UK rather than where they consider their long-term home. And then also, if your clients have been using the remittance basis, there's a small window to bring in any unremitted offshore income and gains into the UK at a reduced tax rate. And if you have clients that have used the remittance basis in the past, but they don't qualify for the FIG regime, then they're going to be taxed on their worldwide income and gains from the current tax year.
Yeah, so I think as Tony touched on in the introduction, obviously former remittance basis users are going to be affected because they won't have access to that anymore. You've just mentioned as well new arrivals, people that are coming to the country either for the first time or after a significant break. But what else should, or who else should our advisors, us as advisors, be keeping in mind when we're thinking about having conversations about this? Because there are some people that are affected and it might be a little bit less obvious.
Yeah, sure. So there will be clients that consider themselves to be non-domiciled, but maybe they've never claimed the remittance basis, so you haven't had that conversation with them. And for these type of clients, I think it's going to be really important to bring up changes to inheritance tax, because long-term residents, so that's going to now be people who've lived in the UK for at least 10 years out of the previous 20, their foreign assets are all within the UK IHT net, regardless of their domicile. And it's not that different to the old regime, but the old regime, you needed to be in the UK for 15 years, so it's
15
just
years,
the
yeah.
reduction down to 10. And anyone that's previously used the remittance basis, we need to be looking at whether they can make use of the temporary repatriation facility to bring it into the UK at a much lower tax rate. And anybody who's claiming overseas workday relief, you'll need to be looking at those rules, because that's now linked to residence instead of domicile as well.
Okay. Yeah, we'll come back to that in a little bit. But you mentioned there this temporary repatriation facility, which sounds like it should be to do with border control or something. But how does it work, and which clients should we as advisors be having discussions with about it?
So it's people that have previously claimed the remittance basis. It's only open to those specific clients, and it's a limited offer to help them bring in any old offshore money at a lower tax rate. So if they've got any foreign income and gains that arose before 6th of April 25, and it's never been taxed in the UK, because they've claimed the remittance basis, they can now remit that to the UK during the current tax year or the following 2 tax years. So that's up to 27/28. And instead of paying the usual income or capital gains tax rates, they can pay a reduced flat rate of 12% in 25/26 and 26/27. But that increases to 15% in 27/28.
Okay.
So there's a clear incentive there to bring the money into the UK sooner rather than
later.
Yeah.
Which I guess that's the hope, because obviously, money
Yeah.
in means, people spending money in the UK or earning interest in the UK is good for the UK economy. So
Definitely.
Yeah, okay. So, as you said, Rachel, so there's incentive to get the money in sooner and have it taxed there. But you mentioned this, the foreign income regime.
Mhm.
Does that apply automatically? Does it apply to everyone? Who qualifies?
No, so it's anyone that's UK resident but hasn't previously been UK resident for the previous 10 years. So that could be somebody that's just arrived in the UK or somebody that's been out of the UK for a long period of time and they've now come back. And it's only available for the first 4 tax years
Okay.
after they come to the UK. Which means that they can bring all their offshore income and gains that are arising into the UK without worrying about any additional tax charges. We don't really know yet what the specific claim will look like because we don't have the tax return for the current tax year. But from what I've read, they'll have to make a specific claim and an election to show which type of fig they're claiming for. So whether that's income, capital gains, or employment income, and then it looks like they're going to have to list out that specific income in order to get it tax free. Another thing to note is similarly to the old regime, if they make this claim, they don't get the UK personal allowance or capital gains tax annual exempt amount for the year. So just like we're used to with the remittance basis, we'll need to do some calculations just to make sure the claim is worth it.
yeah. So presumably, if the amounts are relatively small, then it won't be worth claiming because you'll sort of taking away with one hand and giving with the other, but the amounts won't be the same. So you'll have to compare client's tax position with a claim versus with no claim, but with the personal allowance and annual exempt amount. Yeah, I think you've answered my next question there pretty much. I was going to say, is the regime automatic where the eligibility criteria is met? But you've just said that you're going to have to make a claim, and so that'll be on the 25/6 tax return. So we haven't got those yet, so we don't know what these look like. But I do think, and we were having a chat earlier, I think the Chartered Institute of Taxation has got a working group on this, so it'll be worth keeping an eye on their press releases for information on that. I'm assuming it's going to have to be done on a return. Rather than as a standalone claim. These types of things tend to be automatic triggers for self-assessment, don't they? So
I would imagine, I'd just drop in there that I think there's already a form for domicile and residency, which goes with the self-assessment, which is the SA 109. And in my view, just my view, is that they will probably amend or increase that schedule rather than create a separate self-assessment page for it. They may not, but I'm guessing it'll be part of that. So that's where you might want to look. If you're looking for information, it might come around the SA 109 if you're trying to dig that information out.
Yeah, I think just touching on something that you mentioned earlier as part of the qualify. So for not new arrivers, but returners, shall we call them? That 10-year absence is quite a hard rule, especially if you've got new clients. You're going to really need to look at, because you're basically going to have to look at the result of the statutory residence test going back 10 years if you're not sure, because they've been to the UK. But they haven't been living here. That could potentially be quite a lot of work. If you've picked up a client and they haven't got a comprehensive history of their sort of days and visits and things, that could get quite messy, I guess.
Yeah. So I mean, I think we've covered it in reasonable detail, but and talked about how that income and the foreign income and gains regime will apply. But are there any exceptions, Rachel, that the fee can't be used for?
Yeah, there are, and I think the most important ones to look out for is going to be pensions linked to any UK services or that was accrued during a period of UK residence. and also income and gains from UK property or UK businesses. So that may come into play where something's been enveloped in an offshore company, but it actually derives from a UK source.
So this income will fall outside the figure regime, which means it's going to be taxable.
Yeah, that's right.
Yeah. Okay.
Right. How will that interact with like double taxation agreements then? Because obviously, if you mentioned, if you've got income that hasn't previously been taxed in the UK, but it still may have been taxed elsewhere. So how will that work if you're coming under the new regime?
So the new regime is determined solely by UK tax residents under the statutory residence test. So if you're UK resident under the SRT, you're eligible for the 4-year FIG regime, regardless of what the double taxation agreement says about resident status. But if you end up in a position where you're being taxed both in the UK and another country, you can still use that double tax relief system. Your eligibility for FIG relief doesn't change. So the new rules are based purely on UK law, not international tax treaties.
Yeah. Okay. And you mentioned before overseas workday relief. So we've got changes there. So what's happening with that?
Yeah. So overseas workday relief is also getting a makeover to fit in with the new residence-based tax system. So from April just gone, it's available to anyone who's also eligible for the 4-year FIG regime. So that's if you're UK resident after at least 10 years of being non-UK resident. So as we've said before, that's arrivers and returners. It can be claimed for up to 4 consecutive tax years, but there is a cap on the amount that you can make the claim for. And the benefit of this is that workers no longer need to keep their overseas earnings offshore. So remember, Andy, we used to look at clients together where they'd have to have all different bank accounts and check. You
Mixed
do the
fund
tax return,
cleansing,
you'd have to check that they have left that money offshore. That's all. That should be a lot more straightforward now. So yeah, this is there to help globally mobile employees, but it's being brought in line with the residence-based approach of the other provisions.
Yeah, which makes sense because you wouldn't want to have sort of domiciles going all together, isn't it? Essentially, but yeah, we used to have some fun because I think we were working together when they first brought in the mixed fund rules, weren't we? And we were having to.
Possibly.
Yeah, it was before the cleansing opportunity, but I seem to remember having to go through spreadsheets with thousands of transactions on, and this is clean capital and this is income that needs to go to that account, and it all had to be done before you arrived in the UK or the first day of your resident period in a split year, and so thankfully those days are over, although I don't work in practice anymore, so it's a little bit too late. The damage is done, but
certainly simplifies that position. I mean, you may not like the outcome, but it certainly does simplify the position. It was, as you say, somewhat of a nightmare having to keep transactions or keep a log of transactions separately in order to, and of course with clients, of course, they weren't always especially good at that. So it was sometimes too late to do anything about it. But yeah. Anyway, I mean, so we've looked at income in particular, and we've talked about residence, we've talked about domicile, and the fact the new rules they're residency based. That's the key. No longer domicile isn't an issue. But what we haven't covered is capital gains. Are there any, Rachel? Are there any special rules, different rules for capital gains? Perhaps you. I'm a bit hazy on these myself, so I should be especially interested to hear what you've got to say about it. So yeah, capital gains. What can you tell us?
Yep. So these transitional rules are actually quite exciting if you've got some clients with assets offshore. So clients can rebase the cost of those assets, but only if they meet certain conditions. So one of them is if they've been taxed on the remittance basis prior to April 2025, they're eligible then to rebase their non-UK assets to their value at 5th of April 2017. Now the 2017 year, it does seem rather odd that they picked that, but it's to come in line with the introduction of deemed domicile when that was the new regime. So we're sticking with the date, but we've got a newer regime than that. But what's exciting about it is that if you've never needed to claim the remittance basis, you've never intended to, you can just make that remittance basis claim now on your 24-25 tax return and get this capital gains tax uplift. So
Yeah. And bring the proceeds in without incurring a charge as well.
A further charge. Yeah.
So you can really mitigate capital gains tax there quite simply.
And again, I guess that's there to incentivize people to sell assets now and get the money into the UK.
Exactly. Yeah. So it's so that's just a transitional measure to help people that are moving into this new system to stop them being taxed too heavily on capital gains.
Yeah, or taxed twice, I guess. Because rebasing, essentially, for those who might not know, basically means that you, instead of taking away the cost that you actually paid for an asset or were treated as having paid for an asset, you fix it at the market value as at a certain date. In this case, I guess it's going to be 6th of April 2017. And I imagine if you've held, particularly if it's, say, property for a long time, if you had it for 20 years, that could get most of the gain out of the charge in the first place.
So, sorry, that's one thing there, Rachel. I'm not sure you probably did mention it, but just to be clear on it, this is facility regarding capital gains. It's only relevant for assets acquired before 5th or on or before 5th of April 17. Is that right?
So yes, sorry, I didn't mention that point. Yes, they must have owned the asset on 5th of April 2017. Otherwise, you're just using the actual cost.
So back to the normal capital gains tax calculation, no opportunity to mitigate the tax cost there. So
it's quite interesting, that, isn't it, that they've set the date at the start of the deemed domicile rules coming in. And I guess doing a little bit of lateral thinking there, that's because that would have been the first date that anybody would be in looking at using the remittance basis and then not being able to. So that would be the first year, 17, 18. So that would be the first year that somebody that's not domiciled would be paying CGT on unremitted gains. Fab. Okay, so we've got the old rules, we've got the new rules. Obviously, we're in 24-25, so the old rules are still available for. I mean, the reporting period. Yeah. So there's still the opportunity, as you said, Rachel, to make a remittance basis claim for the most recent tax year, not the current one, quite right. So are there any transitional rules for clients that are sort of caught between the old and the new systems? Because I would imagine there's going to be quite a lot in the UK if they haven't left, of course.
Of course, yeah. So if you have a client that's non-domiciled or deemed domiciled and non-resident in the current year, then they'll stay under the old deemed domicile rules for inheritance tax unless or until they return to the UK. And for any trusts that were set up before April 2025 by people that weren't within the scope for the new IHT residence test, they may keep excluded property status for IHT, but only until the set law then begins to meet the statutory residence test and becomes UK resident again. I think if you've got clients with offshore trusts, then you probably do need to have a conversation with them and make sure that everything's still fit for purpose, because that's a really big change for trusts.
Yeah.
And then we have the rebasing for capital gains and the temporary repatriation facility for old unremitted income and gains that we've already talked about. And these rules are there, I guess, to make the changeover somewhat smoother and to try and prevent some unfair results. But there's always going to be some winners and losers, isn't there?
Yeah. Well, I
When
guess
they make
that.
such big changes.
Yeah. So, yeah, it's interesting you mentioned trusts, and yeah, definitely if you've got clients with, I suppose they'd be called excluded property trusts, wouldn't they? Or yeah, as I remember back in the day, set these up before you become
resident. Yeah.
resident, and then it's permanently outside of IHT, but that's not going to be the case now. So, and they can be obviously quite costly to run, to administer.
Of course.
So you've got to check that it's like you said, fit for purpose, but also, is it value for money, because they'll have their own internal tax rules applying to them wherever they are resident.
Yeah.
Yeah,
exactly.
It's interesting. You sort of painted a picture. I mean, we've run through this fairly quickly, but it's still really clear that this is quite a complex change of rules, and the impact will be many and varied depending on your clients. So I'm guessing really that if you've got someone who's already, maybe recently been in the country, or has been using the remittance basis, or you've got a new client who is coming into the country, or you indeed got a client that's been resident in the UK for a while and is intending to disappear for over to foreign climes, you need to be having a conversation with them in some depth to outline, to map out this. I mean, certainly something we always used to do, but the rules were, I'm not going to say more simple, but they were, the time scales involved were much smaller. You would leave the country, you'd go non-resident, you'd come back and you would pick up where you left off. Now you've got to look at overlapping years, 10-year periods, so on and so forth. So I think it would be right to say you need to identify those clients that are in the sort of circumstances I described, and think whether you need to have a conversation, because there's a chance of either missing the boat with FIG or the rebasing. So I think it's something that advisors should be doing as a matter of course, looking through their portfolio of clients, picking out those that are in that position, and having a discussion with them sooner rather than later, because you need to know what their plans are as well, to give the best. No good. The classic advisor dilemma, and that is having a client come to you and saying, I'm ringing you from Australia or wherever, and saying, what's the position? And you say, well, mate, maybe you should have spoken to me. Yeah, exactly. So you could.
Here's the cart. Where do I put the horse?
Yeah, indeed.
I'll just make a couple of last points that we weren't scheduled to talk about, but I think they're quite important just as reminders. So another thing that I think people need to be thinking about is the excluded property rules for the gifts with reservation and pre-owned asset tax regimes for non-doms previously. That's also going to shift to be based on residence, not domicile. So if you've got a client that's been resident for 10 out of 12 tax years in the UK, non-UK assets could be caught by both the gifts with reservation and pre-owned asset tax, even if they're not UK domiciled. So I think, to sum up, across income gains and inheritance tax, and also these potential anti-avoidance type taxes, if you're a long-term resident, there's a greater chance your non-UK assets are going to be brought within the UK tax net somewhere, if you make gifts or keep a benefit from assets that you gave away. So yeah, definitely have conversations with your advisor.
Right, where does that leave it? I think we've covered all the major points. Is there, I mean, obviously there's a lot of detail here. And I suppose, to preempt the question that you might be asking, Andy, and that is, where next? Where do we find out more? Well, the answer to that question, which you haven't posed, but I've just done it for you, but is that the revenue have created a dedicated manual for this, which you can find in the usual place, and it's the residence and fig regime manual on gov.uk. That's a good starting point. It's clear. It's fairly well written. Obviously, there'd be more to come on that, and that will develop as we get, I think, nearer the time, and certainly there will be some more practical issues that arise, and of course, as we move into the regime more. As we get deeper into the regime, there's bound to be more commentary and ideas around reducing and mitigating the consequences of it. So, that is, of course, not going to be covered in the revenues manuals.
No,
unlikely to be. There have been occasions where the revenue have offered up what appears to be tax saving advice, but so you need to keep your eyes peeled. And I guess
line is always that we do not comment on tax planning.
Yeah, it's a case by case.
Should I open an eye
based
now?
on the
I
facts?
can't tell you that, so because it's tax planning. So
yeah,
absolutely. We'll the usual sources will be developing client focused publications going forward, including ourselves. I know that I'm slated to, well, I say update, but I'll be revamping our book, the tax planning for non-residents and non-domiciles. Well, that's obviously going to need a quite a major update. So I guess I'll probably be spending my summer doing that, or some summer in September. So we've covered the sort of the technical stuff. I'm going to have a look just in the Q&A and just see if we've got any query. Oh, we've got quite a few actually. So let's go through them in order. So the first one: if an overseas client gets UK rental income from the UK and they are living abroad, can they still claim the personal allowance of 12,570? Slightly off topic, but it's the answer is basically yes if they are a UK national, or if they're permitted to do so under a double tax agreement, I believe.
Silence. I mean, if they're in other words, really, if they were entitled to the personal allowance prior to the April 25 changes, there's no reason why they wouldn't be after the 2025 changes. Is the answer. So it's not going to remove any facility for that.
I think to summarise, you can claim personal allowances if you're a UK or an EEA national. So
yes,
that includes residents of the Channel Islands and the Isle of Man, a Crown servant.
Crown servants, of course, yes.
Yeah, or eligible under the terms of a double taxation agreement. What I would say, though, is if you're non-resident but you've got UK income, you probably have to report that on a UK tax return, and you may need to apply for the non-resident landlord scheme if you want to get that income without a 20% withholding tax. Right, next one. If a client has paid, say, 10% tax overseas on their income, when they get the money back in the UK, do they pay the full tax rate in the UK or the difference? So this is asking about double tax relief.
Does anyone want to pick that up? Well, it's the same as it was. I only had one question in mind. So, in other words, it's the difference subject. But of course, initially, you're going to be charged at the full rate, and then you claim the DTR. The DTR is claimed. Double taxation relief, tax credit relief is claimed in the usual way, which will be on, I believe, the SA 106. Of course, if you've got software, it very often doesn't, for completing your personal tax returns, it very often doesn't identify the schedules. You just get, this is the section on X and this is the section on Y. But if you're looking for the pages and the guidance, the revenue guidance, SA 106 and the SA 106 help sheet will be there. So short answer, the difference.
Yes.
But you must pay full tax and then claim the credit.
claim
If
the
you don't
credit
claim the
back,
credit,
don't you?
you're
Yeah.
stuck with the full tax. So, yeah.
Okay, so we've got one here about overseas workday relief. Let's have a look. It looks quite specific, but we'll see how we go. So it says, I understand the foreign income claim, including overseas workday relief under the FIG regime, reduces the pension relief. Does it reduce employee contributions only? Can it affect employer contributions tax relief? So
Yeah.
are we? I'm not
Can you
sure,
just
quite
read that
sure.
again? Can you just
Yeah,
read that
sure.
again, Andy? Yeah.
I suspect what's being asked is, because you're exempting income, does that income reduce your taxable income for the purposes of your maximum relievable pension contributions? But I'll just read it again in case I've
Yeah, sure.
misunderstood. So it says, I understand the foreign income claim, including overseas workday relief under the FIG regime, reduces the pension relief. If that's right, does it reduce employee contributions only? So can it affect employer contributions relief under Section 307 MMR, treaty relief, etc.? That might be something we have to follow up with afterwards, just to
I think that
clarify
might be.
what's.
I mean, if
Yeah.
it reduces the income, if it reduces the income, it will usually reduce the income for pension purposes. Doesn't affect employer. What I can say is it won't affect employers' contributions because they're not linked. They are not affected by the cap on tax relief and
It's
so on
not
and so
linked
forth.
to relevant earnings.
It's not linked to relevant earnings, so it's not going to affect the employer's contribution. They continue to pay whatever they like. Doesn't mean to say that the issue then is, of course, whether there will be any pension-related tax charge as a result of exceeding the either the relevant earnings, net relevant earnings, or indeed the annual allowance or the money purchase annual allowance. But on the detail on that, I think that's something we better come back on. It's an interesting point.
As I say, I'll put my email address in the chat. So if you Mr. Anonymous user, well, everyone's anonymous on here, aren't they? But Mr. or Miss or Mrs. I'll put an email address on, and if you want to follow up and just clarify a couple of points, and we'll do our best to get back to you. Okay, this one then says, if someone is looking to leave the country now, say for 7 years, so they become non-resident, they then bring funds back to the UK. When they return to the UK, it sounds like those funds will be taxable. So this would be, are we talking about income and gains that arise during the 7 years?
I'm assuming that's what they're referring to.
So let's cook up a scenario. So say at the end of this year, I leave the country to work for, I don't know, ACOM Limited in Timbuktu or somewhere. So I'll be earning for 7 years. I then come back to the UK. I don't think there's going to be a retrospective charge for the earnings that I've had in that time period of non-residence. What might be taxable if I mean, we've got it's completely different, but obviously we've already got a system of temporary non-residence for capital gains tax purposes, so I don't think that's affected by these rules. But say, so if someone leaves the country now for 7 years and comes back, they're not going to qualify for the foreign income and gains regime for certain. So if they come back after 7 years and then they have foreign income and gains, that's going to be taxable. Yeah, unless they've only had 1 or 2 years and they're leaving and then they pick up so they can have their 3rd and 4th year of the FIG regime, can't they? Which is what we touched on in the first part. So again, I'll put my email address in the chat, which I'll tell you what, I'll do that now. And then if there are any follow-up questions or any other questions, please do feel free to drop us a line and we will convene, have a look into it and get back to you. Okay. All right. There we go. I'm hoping everyone can see the chat, but if not, it's a.rainford@lefebvre.co.uk, and I've spelt Lefebvre wrong. So
it's a red herring. Try it again, Andy. We'll give you a second. Just concentrate on one thing. Should have got Rachel to do that, obviously. She can multitask, unlike
Absolutely.
you. So yeah.
Yeah. .co.uk. That's a bit of a mouthful, isn't it? There we go. So ignore that first one. Can I delete that?
Yeah. So by all means, if you've thrown the question up onto the Q&A now, yeah, by all means, write in whether or not we've answered it. If we haven't, if you feel we've not answered it fully, or indeed if something else occurs to you after we've signed off, then again, email us on this, and we'll do our very best to answer your question in full. Anyway, we've got any more questions on the board there, Andy?
None so far. So if we just give it a couple of minutes, and then if not, then we'll wrap things up.
Yeah, it's certainly well, I've learned one or two things there, I have to say, and like all these things, we tend to deal with new rules. Yeah, we look at them while we don't forget them. There's no no substitute for actually dealing with something in practice. And it's when you come to deal with it in practice, all we can do is say, all we can suggest is you give your clients the heads up on what's changing. Think of contact those who you think could be affected, might be effective, and then when they come to you for advice, you will have specifics, details, and then you can address the particular points. It's very difficult sometimes to just write and give a client general information, because even if you know their tax affairs fairly intimately, I think you need to just be general, alert them to the problem or the issues, the changes, and then get into a discussion about specifics.
I've just had a look, actually. HMRC has published some guidance just in April just gone, so a couple of months back, about sort of checking if you're eligible. So this isn't the internal manual. This is the more sort of user-friendly, aimed at the taxpayer, but this is quite good. And it's got a couple of examples, actually. So yeah, I'm going to just read this one out because I think this is quite useful. And this is one of these things that, as you say, as we get into the regime and we're advising clients, we'll start to see things that perhaps hadn't occurred to think about initially. But I like this one. So this is about temporarily becoming a non-resident during the 4-year FIG period. So the example says, you're eligible for the regime for 4 tax years starting in tax year 2025 to 26. In the tax year 27 to 28, you return to a country outside the UK and are temporarily a non-UK resident. You then become UK resident again in the year 28 to 29. So you're eligible to claim the regime for the 3 tax years 25, 26, 26 to 27, and 28 to 29. You can't claim the regime in the year you were non-resident, but that just underlines the point that if you have a break in that 4-year period, you can come back and have like your 4th year.
Restart the clock. Yeah.
Well, you'd still only get a maximum of 4, and in this case, you've got 3 because you were non-resident in one of the relevant years.
Oh, I see. So it's not quite restarting the clock. It's actually, I see. Yeah, I understand. Yeah. Okay. So you don't get the 4 years regardless of how big a break. So if you were away not just for that 1 year, you were away for
3 years.
3 years, then that fig.
Well, I think that's
qualifying period expires.
Yeah. It looks like that. It doesn't specifically have an example with a longer break, but the way the implication is, because it doesn't then say 29-30.
Yeah, you'd think okay.
Yeah, this is quite handy, actually. It says, how to claim relief. You'll need to make a claim under the regime on your self-assessment tax return. Yep, so it's got to be a tax return. If you're not already registered, read about self. So you can choose which foreign income and gains to claim relief on. You do not need to claim relief on all sources of foreign income and gains. And then it specifies, coming back there, about the allowances that you'll lose. So you'll lose your personal allowance, CGT allowance, but also married couples allowance, marriage allowance, and blind person's allowance. That seems a bit mean.
That's interesting. That raises some questions in my mind, but I don't think we've got time to go through those now. Certainly something I will look at. Indeed, about the selection of which income you would apply it to, income and gains, because I'm thinking, well, why what are the consequences of not selecting all income? And maybe that's something we need to look at. And I no doubt you'll be addressing it in your updated book, Andy.
I better
so
get
I shall be reading that with interest.
Just the last little bit here is quite interesting as well. It says making a claim under the regime will mean your foreign income will be taken into account when working out your adjusted net income, which is in turn used to work out your entitlements to tax-free childcare and obligations under the high income child benefit charge.
Yeah. So
is that saying it will be taken into account? So are we saying if we make a claim under FIG, we might be more likely to have to pay the high income child benefit charge?
You'd pay it either way, wouldn't you? Because it's
either foreign income or it's FIG income.
You're paying FIG,
Yeah, interesting. Well, I think the couple of points you just raised there, Andy, I think it just shows the breadth of the issues covered. That there are intricacies and small things that you may not appreciate at first that you need to look at. And obviously, we can't. Sadly, I'd like to keep talking and discuss dozens of these, but obviously we don't have time. But it is something, and I will say again, giving it a push. Yeah, your book, I'm sure, will cover a good many of these.
Somebody really needs to go and give this new manual a good read. And I thought, it's going to be me, isn't it? So.
It is going to be you, Andy. Yeah. And I'll be. Don't worry, I'll be reading it afterwards. So So that's
Okay. Yeah. Well. Great. Let's wind it up then. So that's all we've got time for. We're 45 minutes just over. Just leaves me to say thanks so much, Rachel, for joining us and offering your expertise there, fielding the queries. And thanks again to Tony for being so evergreen and always helping out.
Great. Yeah, thanks for that, Andy.
So we'll end the event there, and as I say, do feel free to email us and follow up, and we'll get back to you as best we can. So next one is in September, and I think that's me and you, Tony, talking about the entry of pensions into the IHT regime.
Oh, my favourite topic.
Sounds like a Wagner one, doesn't it? But
it could be not as long as the ring cycle, but it could be a very long. It could be a very long. It could be a very long one. But yeah, it's interesting. I'm writing stuff on that at the moment, so I'm sure we'll have a lot to discuss.
Yes, excellent, and we'll give join-in instructions will be coming out in good time for that. So do keep an eye out for it. Okay, well that's it. So it's bye from me, and see you next time.
See you next time. Okay, thanks, Andy.
Cheers.
Thanks, Rachel. Bye.